In 1996, Apple reported a net loss of $816 million, a figure so devastating it left the company just 90 days away from total bankruptcy. How does a failing computer manufacturer turn a $2.3 billion market capitalization into a $3.45 trillion global empire? The answer is not found in a single product or a clever advertising campaign, but in a series of brutal mathematical choices. To understand how the world of business actually works, we have to look past the shiny glass of the products and examine the reality of 1997. At that time, the operating margin, which represents the percentage of revenue left after paying for the costs of running the business, was negative 14.4%. The company was bleeding cash so quickly that their cash on hand of $1.2 billion was expected to vanish entirely before the year ended. Most people assume a great idea saved the company, but the data reveals it was actually a check from their greatest rival. This brings us to the first major turning point, which I call the Microsoft paradox. In August 1997, Microsoft made a strategic investment of $150 million into Apple. At that time, the total market capitalization was a mere $2.3 billion, which is a tiny fraction of the $3.4 trillion it commands today. Why would the most successful software company on Earth save its biggest rival? While many observers saw this as a surrender, the real signal was psychological. This investment provided the market with confidence that Apple would remain a viable platform. Because of that $150 million, Apple gained the breathing room to launch the iMac G3, which sold 800,000 units in its first 5 months. This specific success did more than just save the company, as it officially returned them to profitability for the first time in years. But cash alone does not fix a broken business model. This is where the power of saying no becomes the primary strategy. When Steve Jobs returned, he found a company working on over 350 different projects, ranging from printers to handheld devices. He famously cut 70% of the product line, narrowing the focus to just 4 core computers. Notice how focus acts as a massive multiplier for efficiency. By 1998, this simplification caused inventory levels to drop from $400 million to just $78 million. In the business world, holding too much inventory is like burning cash, because technology products lose value every single day they sit in a warehouse. This shift proved that doing less can actually result in making much more. By reducing the number of products, Apple could dedicate its best engineers to a few high-impact designs. The next layer of this transformation involved a total operational revolution. While the world focused on external design, the leadership focused on the machinery of global trade. In 1998, the company moved to a just-in-time manufacturing model, which is an efficiency strategy where products are created and shipped only as they are needed to reduce waste. This operational discipline allowed them to scale iPhone production from 1.39 million units in 2007 to a cumulative total of over 2.32 billion units by 2023. What this means for your everyday life is that the products we use are the result of an invisible web of efficiency. To maintain this edge, research and development expenditure now sits at $29.92 billion annually. To put that figure in perspective, it is a larger sum than the entire $28 billion annual economic output of a nation like Iceland. As the company grew, it moved from selling boxes to building an inescapable ecosystem. This is what specialists call the walled garden strategy. Between 2001 and 2022, the company sold over 450 million iPod units. But the real genius was not the hardware, but the integration of hardware and software. By making the iPod work seamlessly with iTunes, the company ensured that switching to a competitor would mean losing your entire digital library. For the average person, this creates high switching costs, which makes it difficult and expensive to leave the brand once you are inside. This strategy transformed the business from a hardware maker into a utility that people pay for every single day through subscriptions and storage. This leads us to the most significant shift in the modern era, known as the service pivot. As the global market reached a point where almost everyone already had a smartphone, the company had to find a new way to grow revenue. In the second quarter of 2024, loan services revenue reached $23.9 billion. On an annual basis, this segment now generates $85 billion, supported by more than 1 billion paid subscriptions. In plain terms, the company has figured out how to generate massive revenue, even when people are not buying new phones. This is a powerful lesson in business durability, as the best companies find ways to make their existing customers more valuable over time. A company's value is not just about what it sells, but how it manages its own shares. Since 2012, the business has spent over $600 billion buying back its own stock. This is a sum larger than the market capitalization of most major corporations in the world. By reducing the number of shares available, the company increases the earnings per share, which is the portion of profit allocated to each individual share. This is a major reason why the stock remains a cornerstone of the global market, making up approximately 7% of the total weighted value of the S&P 500. A 10% move in the stock price directly affects the retirement savings of millions of people who may not even own the products. Despite this historic success, the broader environment presents new challenges. Regional policy shifts in the European Union are also forcing the company to open its ecosystem to third-party stores. This introduces a new risk to the $1.1 trillion in total developer billings that the App Store facilitates. The company is now betting its valuation on a new frontier by announcing Apple Intelligence turned personal data into a private assistant. This move is designed to trigger a new hardware upgrade cycle, as older devices will not be able to run these features. This is known as a catalyst, which is a specific event that forces consumers to act. Apple's story reveals that the distance between bankruptcy and a $3 trillion valuation is measured in discipline rather than luck. In an era of global uncertainty and slower growth, the companies that thrive will be those that build deep moats around their customers. And this is the part that most people never reach. Not because the information is hidden, not because you need a finance degree or a Bloomberg terminal or 20 years of experience on a trading floor, because knowing what happened is only half the equation. The half that actually changes your life, the half that separates the people who watch history repeat itself from the people who see it coming, is understanding why it happened. The mechanism underneath, the incentive that was misaligned, the risk that was mispriced, the assumption that felt safe until it wasn't. That is what we just broke down together. And that framework, that way of reading a situation, does not expire when this video ends. It travels with you. Into the next financial video you scroll past on your phone, into the next conversation about whether now is a good time to buy or sell or wait, into the next headline designed to make you feel something before you have had a chance to think anything, into the next decision, big or small, where someone is counting on you not knowing what you now know. Here is the truth that every story we cover on this channel keeps pointing back to. Money does not move randomly. Markets do not collapse randomly. Companies do not fail randomly. People do not end up broke randomly. There's always a logic underneath, always a sequence of decisions, incentives, and miscalculations that, when you see them clearly, make the outcome feel almost inevitable. The tragedy is never the collapse itself. The tragedy is that the signals were there the entire time. Visible, readable, understandable, for anyone who knew what to look for. Whether we are talking about a trillion-dollar empire, a housing market on the brink, or the way a single household manages its monthly budget, the laws of gravity remain the same. You cannot build a skyscraper on a foundation of sand, and you cannot build a future on a foundation of financial illiteracy. That is the only edge that actually matters in the long run. Not a hot stock tip, not perfect market timing, just the ability to read the room before everyone else does. It is about shifting your perspective from being a passenger in the global economy to being someone who can actually read the map. Because when you understand the map, the scary headlines lose their power over you. You realize that most of the noise is just that, noise, designed to keep you reactive rather than proactive. In the world of finance, the most expensive thing you can own is a closed mind. Most people lose money not because they are unlucky, but because they are operating on outdated maps. They are playing a game where the rules changed 10 years ago, but they are still following the old guidebook. By looking at the specific case study we discussed today, you've essentially just updated your software. You've seen how the gears turn behind the curtain. And once you see the machinery, you can never go back to just believing in the magic trick. The path to real wealth isn't paved with complex algorithms. It's paved with the patience to learn and the courage to act on logic when everyone else is acting on emotion. It's about recognizing that every financial disaster and every massive success is just a human story told through numbers. So if this video sharpened something, if it made one concept click that was blurry before, if it gave you one framework you will carry into a real decision, then you already know what to do next. Take that insight and apply it. Don't let it sit as entertainment. Use it as a lens. The next time you see a company skyrocketing or a market dipping, ask yourself, what is the underlying incentive? Who wins if this continues? Who is carrying the risk that no one is talking about? True financial wisdom isn't about knowing everything. It's about knowing how to think about everything. It's about building a mental fortress that protects your capital and your peace of mind. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.